Hello and welcome to Business Today Television. I am Siddharth Zarabi and with me today a market expert, Sanjiv Bhasin, Director of IIFL. 2022 has been a volatile year for our markets in India as well as globally. How will 2023 prove to be for the Indian markets? What are the trends that we can talk about at this moment? I'll come to you now on that, Sanjeev, and on a day when we have had election results in 2 state assemblies. And using that cue, I want to take off from the macro before we come down to the micro and specific companies and sectors and themes. Gujarat was once again by the BJP, but Himachal has been lost, and among the factors that is being blamed for it is the promise of the old pension scheme, a scheme that was done away with 18 years ago. And in a state like Himachal, which is dependent on state employees as a very important political bloc, does it mean that we are in for a tough time fiscally in the run-up to the Lok Sabha election?
Yeah. Good evening. So, Siddharth, I'm not a politician by nature. But if you ask me, all these are, question marks on the long-term status of BJP and how they've powered their way into various states where Congress was dominant. Whether it's the anti-incumbency or this pension, I don't know. But Himachal has a history of changing governments every 5 years. Notwithstanding that, the Bank Nifty has hit an all-time high, and it tells you that the stock market is a barometer of future earnings, and India has been an outlier. Now, you are right that in the next year, there will be some freebies and some pressure on the government to announce measures related to, politics. But I think that this government has handled itself very, very credibly, given the status of COVID and beyond. That's why we didn't print money, and India has been a far outlier globally. So I think that our, both fiscal and monetary policy have been relatively much more stable than globally. And I think we will get past this hurdle. Let's enjoy the new highs, and then we'll take it when we come to the next halt of what the elections and so on. There is still some time to go. Let the others come in, because the feeling of missed out is so humongous that all declines are being used to buy. And I think the stock market is actually the correct what we call barometer of what Modi ji's policies and the government's outperformance has been.
Wonderful, and that's an important point that you make, Mr. Bhasin, because we have several state assembly elections next year, and those are playing out on the screen. I just wanted to set the macro context for 2023, because this conversation is about the outlook. So the first question really that I want you to tell our viewers about is, taking off from what you spoke about, those who missed out, do they have a chance in 2023? And if they do, how should they go about constructing this approach?
So, Siddharth, 3 things. Firstly, I am a retail investor person, and pan India, I have a lot of following. I traveled last 16 weeks. I've been doing cities in India. That is where the real wealth lies. It is not in the humbug foreign investors who got it all wrong. They sold in fear at 15,500, and now in greed they are making the index go to 19,000. The retail investor is who is putting his money where his mouth is, and he is not driven by this volatility, because he is using the SIP as a very good instrument and creating an asset class called equity, which has been absent in 140 crore population. We just still have 10-11 crore demat accounts. That is where the real value of India and the future lies. India is an expensive market. We are getting even more expensive. I don't think we will be able to continue to outperform like we have. There is the budget. There are going to be a lot of the other headwinds. But I still think equity as an asset class, because of the reason I mentioned, the retail investors return, and he's going to be here for the long stay, is going to be that we will be having valuations which are expensive. Just to give you an example, at 11 crore demat accounts, if Reliance is at a market cap of 20 lakh crore, then in 5 years, if this market cap, if this becomes 15 crore or 18 crore demat accounts, then Reliance will become 30 lakh crore. You get my point. So blue chips will always be in fashion and at expensive valuations, but there is still money to be made depending on who you have been chasing or how your mutual fund allocations are. We still think the mutual fund route is the best because the fund manager is unpassionate about stocks, about relative stocks. He's looking for outperformance on your portfolio and he's not emotional. Thirdly,
What kind?
I think that the foreign investors have had a huge feeling of missed out. And despite the rupee weakness, which is a global chaos because of the dollar, we think as soon as rates settle in the US, there will be even more money coming into India. But like I said, we are not a cheap market. We could see a steep correction closer to the budget. So if you can go through the volatility for the next few months, then I think the longer term picture looks good.
What will trigger that correction? Are you alluding to even further tighter money, or are you alluding to growth concerns, including what is happening globally?
Yeah, so the global picture is quite dismal. In fact, the elephant in the room is Europe, and you've seen that nobody on earth knew how much of Europe's reliance is on oil and gas from Russia, which has caused all this rumbling on the dollar, the euro hitting a new 30-year low, inflation hitting 40-year highs. So in all this chaos, India stands out. But like I said, Indian valuations are relatively stretched because of the advent of the retail mutual fund and the advent of the retail investor into money. I think that the correction will come because chaos or no consensus on buying everything is going to be, discounted by the market. You have a budget, you know that fiscal and the other policies will be under pressure. We still think that the rupee has been a relative outperformer despite being a very, very weakling against the dollar. But like I said, having run up quite a bit, we should see some sort of consolidation stroke correction, which will be healthy for the market closer to the budget.
Okay. One quick point before I get into some thematic component. One of the things, this global slowdown that you spoke about, Sanjeev, is the fact that crude oil is now below 80, and we know that when crude oil goes below 80 or when it goes above 100, there is a strong correlation with overall growth momentum in India. Is this a positive development? And also, if you could tell our viewers about the growth versus valuation mix. If growth is going to dip in India, which everyone is saying, then shouldn't valuations also correct because corporate earnings will get impacted?
Yeah, no, the crude argument has always been, that India was totally dependent. 65% of our import bill is crude and gold. But, we are not that 20-year-old economy. And in fact, at 120, we weathered the storm well. Even though crude is at $90, look at the demand for autos. So I think this is a misnomer that oil prices will, see the collapse of the Indian rupee and the Indian economy. That is not to be. We are much more resilient than before. And now that we've got a very, very good, ally in supply from Russia, it has given us a benchmark of being much more, safer. On the crude volatility, it is difficult. You should be asking JP Morgan, who in June had predicted 358 and now says $70. So like I said, the FIs have got it all wrong. For us, this band is relatively easy. But remember, Siddharth, the biggest correlation of crude rising means global growth is back. If there is a recessionary fear, which is what bond yields in the US and Europe are telling me, then crude prices cannot rise. There is no demand. Plus, you have the China COVID shutdown, which is slowly reopening. You have the Eurozone problems, which is again an indicator that crude being weak is a harbinger that there are tough times ahead and demand is in a recessionary type of an environment. For India, it seems on a good note because crude lower means that our import bill and our rupee and our bond yields all get impacted. A. B. The investment part of India being on a slower growth is 6.5, 7, which most of the rating agencies are saying. But that's a far outlier than what is happening around the world. And like I alluded to you on the first point, that the retail investors' flow of equity, liquidity into the system is going to make in India a slightly more expensive market than the rest of the Asia emerging market basket. And you will have to live with that if you have to invest for the future.
Okay. You spoke about auto. What's your sense about the auto sector in 2023? Because apart from supply side, there has also been a bit of a structural shift in terms of demand, Sanjeev.
Correct. And you know that the supply chain disruption because of China, because of the semiconductors, all those are getting sorted out. Maruti itself says that there will be a demand of 35 lakh autos, and they've been selling something like 18 to 20 lakh in a year. Now you can imagine if they are saying a 50% upside, then what's the demand for the Alto or the new Ertiga? Similar is the case with Mahindra, who is seeing a 2-year waiting for the new V700, and I can go on. I think the next leg of auto will be the two-wheelers, because rural incomes were impacted. Now they are coming back because of a good harvest. The cost of money has been relatively stable. With inflation moderating, it will be the two-wheelers which will drive growth. But I think select OEMs, these are going to be the ones which will drive the craze. We've seen the likes of Apollo Tyre, we've seen the likes of Bosch, we've seen the likes of Motherson, and we think some of these global players will get a lion's share of the business because of this China one and Eurozone, where a lot of the PLI now is being shifted towards India.
That's a very good point that you make towards the end, because one of the underlying themes of the supply side disruption, and this is anecdotally what I have heard about, for example, in Pune, which is a significant auto cluster, is that even those small components that were missing from our auto supply chain, they have also integrated within India. And that's been a response. That's a very good point. Let's talk about banking. And in banking, one of the themes that I have seen, at least from the last quarter results, is gangbuster results, Sanjeev, with the PSU pack. And we've been discussing on the channel whether this is the moment of the big PSU banking turnaround. What are your views about the banking sector in 2023?
Well, Siddharth, go back to 1 year back or to 6 months back. I have been a bull on the PSU banks, and despite I'm a patriot or an Indian bull, which they call me a market guru, but PSUs have been the biggest wealth creators in the last 1 year, and they were the biggest wealth destroyers in the 5 years. So remember, every duck has its day, or everyone has its day in the sun, and PSUs have never shown like before. Only thing, stocks have doubled, tripled, or maybe 4 times in the last 1 year. So take it with a pinch of salt, that do not just rush into the trade because it's a blind trade right now. But you are right. For them, the right backs in the shape of coal, power, infrastructure, these were write downs, and these industries have turned around. Steel, cement. So the large corporate lenders have seen capital come back, and they've been very, very sweet in their performance. So capital is not an issue, and we think the lending side is doing extremely well. So retail banking is where the money lies, and PSUs have taken a lion's share of that. And we still think that at least for the next 1.5 to 2 years, the level of NPAs or others will take time to come when they do. So right now they are in a very sweet spot. Only a caveat that they are now fully stretched on the valuations. Wait for some corrections, because that is inadvertent after the sharp run up.
What about HDFC and ICICI?
Well, those are the bluest of blue chips. HDFC, ICICI, Kotak, ICICI Bank, Axis. So you have to add those to your basket. And that is what the market is indicating, that despite higher yields...
At what price? At what price? Sorry to interrupt you. At what price? What is the price that an investor should be willing to fork out to enter these blue chips?
No. So you should do a SIP in the Bank B's ETF. Bank B's ETF are hitting new highs. I can understand. And that is what I was telling you, that the Bank Nifty has hit a new high, and it did that before the Nifty hit it. So the Bank B is the best indicator for you to buy. Try and spread your SIP over a month, or monthly or weekly, whatever way you want. But that will give you a combination of 6 of the PSUs, 6 private banks, which include HDFC and ICICI and Axis. and that should be a good benchmark for you to try and chase stocks. Don't go for individual stocks because you could get hurt. A basket or an index will be a much more safer place to play. They are hitting new highs, but if you do a sip, you will get couple of bad quarters also, and you will be able to manage your book over there.
Sanjeev, what are the other themes that you yourself feel the retail investor, because that's what we have been largely talking about during this conversation, should look forward to in 2023?
So like I said, look at the second-hand mortgage lenders. After HDFC, the third largest lender is a company called Canfin Home. Canfin Home's MD resigned 6 months back, 3 months back, and went to PNB. And there was a chaos in the stock for whatever reason. It was most unwarranted. We used that opportunity to buy. Canfin Home's management is now saying that the second half of the year will see double the business it saw in the first half. Cost of money is much lower for them than the other lenders. They are the third largest player in the 15 to 30 lakh ticket loan size. And like I said, the valuations are very, very reasonable. They have a delinquencies of not even 0.2%. This is one stock or a sector which I'm very, very bullish, because mortgage lending is doing very well. We have a target of 850 on this stock. Second would be both the OEMs, Bosch and Motherson. Both are global players and are setting up more bases in Europe and Algeria and others, because they are readying themselves for the return of Europe. And if you saw, the month of October saw the highest car sales in Europe, which is tentatively the most hurt continent right now because of Russia. So I think these two global players on the OEMs, both Motherson and Bosch, could be outliers. We like the cement play, as in Gujarat, Ambuja and Ultratech. Ultratech, the largest player, is a very, very, it is the biggest market pricer, and 120 million tons of capacity means that this stock can be raring to go as we've gone through the chaos of higher coke prices and fuel prices. That should marginalize. And then look at some of the, auto plays like an Ashok Leland on the four-wheeler, or a Eicher Motor in the two-wheeler and the bus market. All these are boding well. So take a basket of stocks, select mid caps, select large caps, but at 19,000, 50% should be in large caps.
50% should be in large caps. As we wind down this conversation, just 2 or 3 quick points. One, 2022 has also taught investors a lesson once again about IPOs. But my question about 2023 is, do you expect the big bang IPO, some people have spoken about it, for example, Jio Financial Services or the telecom business itself? What are your thoughts about that?
So Siddharth, look, there will always be, what we call anxiety when you miss out on a market. When the last time we were at 18,500, all these fintechs came with issues. Some of them are run brilliantly. They are brilliant businesses, but the investment bankers left no money on the table. Right. And I'll tell you another anecdote. I've spent 33 years in the market. Abhi 18,500, everyone will say, give me a 5-year story. And when the index comes to 16,000, it will be just for 5 days. So you cannot but see greed and fear when you hear these IPOs. Don't chase them unless you have a window of 5-7 years, because these are going to be not driven by profit. They are driven by the model, and some of them may be extremely good, but they need time, they need gestation. They are not going to become dividend paying overnight. So if I name one of them, Nykaa and Zomato, we think those are perfectly fitting the bill. After a correction, you can add those. Paytm may give you a trading bounce. On the Jio Financial and the others, we'll take it with a pinch of salt. Some of them will be very, very attractive because their presence is now one of the, it's a hallmark in everyday life of yours. So we will wait and see how this pricing takes in. But like I said, don't chase stocks at all-time highs, because there is room for disappointment, because you don't have a longer gestation period.
Right. So even as we talk about inflation and the macro, you've given us several micro points. My last couple of questions. If someone had 10 lakh rupees to invest in 2023, where should he put that money?
Well, just now I think debt is giving you a very good flavor. We know bond yields are hitting highs. So partially in debt, depending on your age profile and your risk profile. But if you wanted to do an equity investment, then I think, like I said, the Nifty Bs and the Bank Bs or a mutual fund would be ideal for you. Do not do personal stock tips or something on TV, which we all say, because you are not going to be able to book losses when the time comes for churn. Just to give you an example, IT has been one of the most steadiest ships in the last 2 years, but this year it has miserably underperformed. So the fund manager is easier going to change from Infosys into ICICI Bank and make more money. If you can do all that finish, then it's better to you do your own portfolio. Otherwise, let a fund manager or a mutual fund handle your money.
Okay, and if someone had 1 crore?
Well, 1 crore doesn't need advice. He already knows what he is doing. But like I said, if you have the longer term vision, Siddharth, I cannot be a wonder boy at 64,000. I still think Indian markets are poised for more highs, but take it with a pinch of salt that before the budget, there is a sharp correction on the way.
Absolutely. And watching levels might be a good way to spend time, but levels are not triggers for investing. Sanjiv Bhasin, thank you very much for that wonderful, clear-headed insight into the markets in 2023. As we always say, stay invested, stay safe, and save, invest, prosper. Remember the SIP mantra: save, invest, prosper. With that, it's a wrap on this conversation. I'll be back with more. Keep tuned in to Business Today Television.